In the span of 48 hours, silver went from looking like a steady, liquid market to behaving like a trapdoor. One moment it was flirting with record territory, the next it was printing moves that belong on crisis charts. In India, the MCX March silver contract was reported to have dropped about 17% in a single day on January 29, 2026, roughly a 68,000 rupee hit per kilogram. 29. That's a one-day collapse of about 31%, not months, not weeks, in 48 hours. And the part that breaks normal expectations is what didn't happen. Instead, the stress showed up in the plumbing, how expensive it suddenly became just to hold the position, how quickly forced selling could cascade, and how the paper market could swing while the physical data looked oddly calm. For years, people said silver was too deep, too global, too liquid for sudden structural stress. They said the market had matured, and the tape-printed numbers that sounded like a different century. Here's what most people miss. Institutions don't need you to believe a story. They just need the system's rules to change. When the rules change, money moves before the explanation catches up. What I'm about to lay out is not opinion. It is pattern. And once you see it, you stop watching silver like a shiny object and start watching it like a mechanism. That is what this video is about. Not hype, not predictions, the setup, the zone, the specific band on the chart that, if cleared and held, has historically been the point where silver can run fast. Not because of emotion, but because of mechanics. Welcome to Macro Signal, where we decode what matters before it becomes the headline everyone repeats. If you've been here before, you already know the approach. We don't argue with takes, we map incentives. If you're new, consider subscribing the way you'd listen to the one calm voice in a crowded room. And let me know in the comments where you're watching from, because the silver story looks different depending on whether you're pricing it in dollars, rupees, or something else entirely. Now, let's reconstruct what actually happened, because the timeline matters. 2% to roughly 9% of contract value. That sounds like a footnote until you translate it into behavior. When margin rises, the trade becomes heavier to carry. The same exposure now demands more collateral, and that collateral has to be posted in a world where cash suddenly has a higher value. At the same time, the public narrative was simple. Silver was racing toward the psychologically loud number, $100 an ounce. Commentators were talking about the round number as if it were a magnet, but the market was whispering something else. The cost of leverage was rising into the rally. That's the opposite of a carefree melt-up. That's a rally with a tightening belt. Then the reversal hit, and it didn't just hit silver. Gold and silver were both described as suffering a historic sell-off and then rebounding sharply over the next sessions. 2%, putting it near $87 and change. When you see that kind of sequence, crash, snapback, continuation, you're looking at a market where positioning is being forcibly rearranged, not calmly rotated. The scale of the volatility matters because it changes how the ecosystem behaves. When gold is trading in the $5,000 range and can drop more than 9% in a day, it sends a message to every risk desk. Correlations are unstable, and leverage has to be rationed. 82, while also noting that the initial plunge was the worst one-day drop in decades. In that kind of environment, the metal itself becomes less important than the volatility it is producing. Notice what the narrative trigger was, too. The story around the sell-off included two catalysts that operate through expectations and through rules. Shifting assumptions about the future path of U.S. interest rates and exchange margin hikes that tighten the cost of participation. The first changes the macro backdrop, the second changes the mechanics of holding risk. When both hit at once, you get a market that can gap violently because the marginal participant doesn't have time to adjust. This is why some research outfits frame the recent drawdown as historically rare. One summary of the week's damage described a plunge that was as much as 36% from the high and pointed out that over nearly 6 decades, there were only a handful of comparable declines of more than 20% from an all-time high. The important point isn't the exact count. The point is what it implies. When silver breaks in this way, it's not behaving like a normal uptrend pullback. It's behaving like a leverage unwind, and liquidation events have fingerprints. You see them in the speed of the move. You see them in the mismatch between the futures tape and the physical tone. You see them in the way commentators immediately split into two camps. Those contradictions aren't noise. They're a sign that the market is transitioning between regimes, and regime transitions are exactly where fast runs can start. There's also a structural reason silver is prone to this kind of behavior. It sits between two worlds. It trades like a monetary metal when fear is rising, but it is also an industrial input tied to manufacturing cycles. That dual identity makes the order flow messy. In the same month, you can have investors buying it for protection while industrial users hedge it to control costs, and those flows collide in the futures market. When price moves into a headline zone, the market's attention compresses, and the next move can accelerate. That's why paper versus physical keeps returning as a theme. Paper sets the headline price instantly. Physical determines whether a large buyer can actually source, finance, and move metal without paying a hidden premium. The public sees a single price. Professionals see a chain: spot, futures, spreads, financing, inventory location, and deliverability. When that chain tightens, the market can lurch. When it loosens, the market can glide. Late January looked like tightening, then snapping, then tightening again. And once volatility becomes the story, attention shifts from price targets to survival. So where does the zone come in? In early February 2026, silver has been wrestling with the high 80s into the low 90s. The 90 area has become more than a number. It has become the test. Some snapshots put spot near $89 to $90, and the market has repeatedly shown that it can reach into that band, but holding it is the hard part. That matters because this band is where the market has to prove it can absorb volatility and higher collateral costs at the same time. If silver can clear the 90 to 92 area decisively and then hold above it, the market structure can create a runway. But you can't understand the setup without seeing the hidden pattern. Silver has a history of doing something very specific during stress regimes. It goes quiet, then it goes violent. And the violence clusters around moments when leverage meets rule changes. In 1980, silver's move became a case study. The price had surged to roughly $49 and change per ounce in January, and futures even printed an intraday high above 50. Then the regime shifted. Exchanges tightened rules. Financing got harder, and the market discovered that a crowded leverage trade can't exit through a normal-sized door. The lesson wasn't that silver can't rally. The lesson was that the rally can turn into a collapse when the system demands more collateral than the crowd can provide. In 2011, the pattern returned with modern tools. Silver pushed to around $49.80 per ounce in April, and then the market endured a sequence of margin increases and a rapid reversal. The details differ, but the structure rhymes. A fast climb, rising participation, and then a tightening of leverage conditions that turns normal pullbacks into cascades. Now in 2026, we're watching the same rhyme, but with a twist. The supporting data isn't clean. Two true data streams are telling opposite stories, and that contradiction is where the signal lives. Start with positioning. The CFTC's Commitments of Traders report is one of the few weekly windows into who is long, who is short, and who is hedging. 7K. That's not a dramatic collapse, but it's directionally important. It implies that as volatility surged, the speculative crowd was not simply piling in with fresh leverage, it was trimming. That matters because it suggests the market's violent swings weren't just a euphoric crowd getting louder, they were a system rebalancing risk. At the same time, the physical proxy many people watch, large ETFs, was not collapsing. 59 tons as of February 2nd, 2026. 16,500 tons is a mountain of metal. If the story were everyone is dumping silver, you would expect that figure to be bleeding lower in a way you can't miss. Instead, the holdings number gives a different signal. Whatever is happening, it is not a simple one-direction liquidation of the biggest pooled holders. And then there's London, 30% increase from the prior month. Again, on its face, that seems to contradict a pure scarcity narrative. If silver is in a squeeze, why are reported vault holdings rising? If inventories are comfortable, why is price behaving like supply is tight? This is the dislocation. The price action screams urgency, but the inventory snapshots look stable to rising. The futures market is being made more expensive to trade, but positioning shows specs trimming rather than piling in. In other words, the market can have plenty of metal in the world and still experience localized tightness in deliverable form, at the right place, at the right time, under the right collateral rules. Paper can move at the speed of a click. Physical moves at the speed of logistics, financing, and trust. When the two are aligned, silver trades like a normal commodity. When they diverge, it trades like a referendum on the system. Start with the exchange. CME Group sets the performance bond requirements that determine how much collateral is required to hold a silver futures position. 2% to around 9% of contract value. Every participant has to reevaluate leverage. Commercial hedgers feel it, speculators feel it, market makers feel it. Even if you do nothing, your position becomes more expensive to maintain than look at the participants who amplify the move without intending to. Systematic strategies, including trend followers and volatility targeting funds, can reduce exposure when volatility spikes, regardless of their fundamental view on silver. Dealers can become forced hedgers when options positioning gets skewed. If customers are long call options and dealers are short those calls, the dealer's hedge can require buying as price rises and selling as price falls, which can accelerate both directions. Layer in risk managers who tighten limits after a shock, and you get a market where liquidity can vanish right when everyone wants it. That's why the late January timing matters. A market accelerating toward a round number, $100, while the cost to hold rises, is a market in which upside can become reflexive if it breaks through, but downside can become violent if it fails. That's the run fast setup. The zone becomes the fulcrum. So let's define the zone cleanly. The zone is not a magic line. It is a band where multiple forces overlap. Previous highs, round number psychology, collateral pressure, and positioning thresholds. In this case, the band around 90 to 92 is where the market has been fighting. Above it, stop orders from shorts and momentum entries from systematic strategies tend to cluster. Below it, profit-taking and deleveraging tend to reappear. The reason silver can run fast after clearing the zone is that the order book often becomes thin in the space above it, because sellers have already been exhausted and because buying becomes self-reinforcing through hedging dynamics. But the proof is in the numbers and the contradictions. 7K, while price was still capable of sharp rebounds, that implies the move is not solely a crowded speculative stampede. 59 tons, it suggests the biggest passive pools are not dumping in panic. If London Vault holdings are 27,118 tons and rising, it suggests stock exists, but maybe not in the form, location, or financing posture the futures market needs at the exact moment stress hits. Now here's where it gets interesting. When a market shows rising reported vault holdings while price is violent and margin requirements are rising, it can mean the system is prioritizing safety over fluidity. Participants park metal in the most recognized vaulting network because credibility matters during stress. They want assets that are unquestionably deliverable, unquestionably audited, and easiest to finance. That can make headline vault numbers look comfortable, even as the free float that can actively meet sudden delivery demand tightens. Think of it like a city with plenty of water in reservoirs, but sudden restrictions on how much can move through the pipes at peak hours. The water exists. The pressure at the tap still drops. The price response in a market like silver is not just about existence. It's about flow. Now translate that into mechanism, because this is where most coverage stays too vague. A margin increase does not directly change the value of silver. It changes the capital efficiency of the trade. A standard COMEX silver futures contract represents 5,000 ounces. At $90 an ounce, that is $450,000 of notional exposure. At 9% margin, the initial performance bond is roughly $40,500 per contract, before you even talk about variation margin from daily moves. When volatility spikes, daily settlement becomes the real battlefield. If price drops, longs owe variation margin immediately. If they can't post it, they are closed out. Those liquidations push price lower, which creates more variation margin calls, which creates more liquidations. Then, if the market snaps back, the same process can hammer the other side. Shorts who were comfortable suddenly face losses plus higher required collateral, and some are forced to cover, which adds fuel to the rebound. This is why a market can crash 31% one day and then stage a double-digit rebound shortly after. It's not serenity, it's forced repositioning. This is also why dramatic one-day moves tend to cluster. Once a market shows it can move 17% in a day in one venue or 31% in a day in another, risk managers don't treat the next session like a normal day. They widen limits, they reduce size, they demand more cash. Liquidity thins, and thinner liquidity makes the next move sharper. That is the paradox. The more volatile a market becomes, the more it sets itself up for even more volatility. So what does the data suggest going forward, without turning this into a prediction? Historically, there are three scenarios that tend to play out after a margin and volatility regime shift. The conservative scenario is stabilization. Price chops around the zone, volatility gradually compresses, and the market digests the new margin regime. In this scenario, the key is whether spot can hold above the high 80s and whether futures spreads normalize, signaling that carry and financing are no longer screaming stress. The moderate scenario is a clean break higher. The market clears the 90 to 92 band, holds above it, and then accelerates toward the next shelf. The reason the acceleration happens is mechanical. Stops get triggered, systematic funds add exposure, and dealers hedge options exposure by buying as price rises. In that environment, a move toward the 100 handle can happen quickly because the number itself becomes a coordination point for flows. The aggressive scenario is a break and a snapback. Silver spikes through the zone, tags the next level, and then reverses violently as margin pressure and profit-taking hit at the same time. That's the pattern you've seen in past episodes where silver briefly overshoots, then teaches the market a lesson about leverage. So, what do you watch if you want to understand which scenario is unfolding? You watch the same three categories that revealed the stress in the first place. First, watch collateral policy and exchange messaging. When methodology shifts and requirements change, that is the exchange telling you volatility risk is being repriced. A second increase tends to amplify forced behavior. A pause tends to calm it. Second, watch positioning. If net speculative exposure continues to drift lower while price rises, that's a sign the rally is being driven by hedging and structural flows rather than pure speculative crowding. If speculative positioning rises rapidly into the rally, that's a sign the trade is becoming crowded again, which raises the risk of another margin-driven flush. Third, Watch physical proxies. Okay. If Vault holdings begin to fall while price is still rising, the scarcity narrative strengthens. If holdings rise while price rises, the story may be more about safe custody and financing than about depletion. Now we come back to the title. If silver clears this zone, it can run fast. That statement is not a promise. It's a description of how markets behave when a congestion band sits right below a psychological number and the collateral regime is tight. When the market is forced to choose, it tends to choose quickly. And this is where the viewer positioning matters. The people who get blindsided by moves like late January are not necessarily uninformed. They are focused on the wrong layer. They watch the headline. They watch the round number. Meanwhile, institutions watch whether the market's plumbing can carry the load. They watch margin. They watch settlement. They watch the cost of carry. They watch positioning. They watch which data streams disagree. That gap in attention becomes a gap in outcomes. Not because anyone is smarter, but because they are measuring different things. Retail often moves last because retail receives the story after institutions have already read the signals in the infrastructure. So here is the takeaway. The 90 to 92 band is not just a technical line. It is a referendum on whether silver can sustain higher prices under higher collateral costs and chaotic volatility. If it clears and holds, the path to the 100 handle can open with surprising speed because the market structure can create a vacuum. If it fails and slips back under the zone, the same structure can create another flush because leverage does not negotiate. This is macro signal, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether the market stays volatile. The question is whether you'll recognize the setup before the next fast move forces everyone else to.